Have you ever wondered why the stock market captivates so many people around the globe? It's a question that beckons an exploration into the world of finance, a world that is not only influential but also intriguing. From Wall Street to Shanghai, the stock market is a global phenomenon. It's a place where fortunes are made and lost, where dreams are realized and shattered, and where economic powerhouses are born. It's the pulse of the global economy, a barometer of financial health and a forecast of future prospects. The allure of the stock market is multifaceted. For some, it's the potential for profit that draws them in. Investing in stocks can be a lucrative endeavor, turning modest sums into substantial wealth. When a company prospers, so do its shareholders. This potential for profit, for seeing one's investments grow, is a powerful motivator. For others, it's the thrill of the trade. The stock market is a dynamic and ever-changing entity, with prices fluctuating from moment to moment. Buying and selling stocks, predicting trends, outsmarting the market. It's a game of strategy and wits, a high-stakes dance that can be both exhilarating and nerve-wracking. But beyond the personal gains and the adrenaline rush, the stock market plays a pivotal role in economic development. It provides companies with the capital they need to grow, innovate, and make strides in their respective industries. It fuels job creation, boosts productivity, and fosters economic growth on a grand scale. The stock market has also been the stage for some of history's most notable moments. From the Wall Street crash of 1929, which ushered in the Great Depression, to the tech boom of the late 90s and the financial crisis of 2008, the highs and lows of the stock market have left indelible marks on our collective history. Understanding the stock market can unlock a world of opportunity, but first we must grasp the basics. So let's delve deeper into this fascinating realm where finance meets strategy, where risk meets reward, and where every decision can make a world of difference. What exactly is the stock market and how does it function? Well, allow me to break it down for you. At its core, the stock market is a place where buyers and sellers come together to trade shares. Now, what exactly is a share? Simply put, a share represents a portion of ownership in a company. When you purchase a share, you're essentially becoming a part owner of that company. This brings us to the concept of supply and demand, which is the driving force behind the stock market. When a company performs well, more people want to buy its shares, driving up the price. Conversely, if a company isn't doing so well, people may want to sell their shares, causing the price to drop. In essence, the price of a share is determined by how much people are willing to pay for it. Now let's talk about stock exchanges. These are the places where the buying and selling of shares actually takes place. Some of the most well-known stock exchanges include the New York Stock Exchange and the London Stock Exchange. These exchanges serve as a platform for companies to list their shares and for investors to trade them. Next, let's delve into the difference between public and private companies. A public company has sold at least a portion of itself to the public through an initial public offering or IPO. This means that shares of the company are openly traded on the stock market. On the other hand, a private company has not sold any part of itself to the public, meaning its shares are not available on the open market. So to recap, the stock market is a marketplace for buying and selling shares, which are pieces of ownership in a company. The price of these shares is determined by supply and demand, and these trades take place on stock exchanges. Furthermore, only public companies have shares available to trade on the stock market. So, the stock market is a complex system of buying and selling ownership in businesses. But how can you, as an individual, get involved? How does one become a part of this vast global marketplace, you might wonder? Well, let's dive right in. The first step towards becoming a part of the stock market is setting up a brokerage account. Picture this as a bank account, but instead of storing money, it's a place where you keep your stocks and other securities. It's the gateway to the trading floor, where you can buy and sell shares of companies from around the globe. Once your brokerage account is set up, it's time to start researching stocks. This might seem like a daunting task, but don't fret. There are plenty of resources available to help you make an informed decision. You can look at a company's financials, its performance in recent years, and even its future projections. The key here is to understand what you're investing in rather than just following the crowd. After you've done your due diligence, it's time to place an order. This is where brokers come into play. They act as intermediaries, executing your orders on your behalf. You tell them what stock you want to buy, how many shares you want, and they make it happen. Now, there are different types of orders you can place. A market order, for instance, is a request to buy or sell a stock at the current market price. A limit order, on the other hand, allows you to specify the maximum price you're willing to pay or the minimum price you're willing to accept. There are also stop orders and stop limit orders, which are a bit more complex but can give you more control over your trades. So, there you have it. You've set up your brokerage account, you've researched your stocks, and you've placed your order. You are now a player in the vast global marketplace that is the stock market. Now that you're aware of how to enter the market, it's crucial to understand the different strategies you can employ. But we'll save that for the next scene. Until then, happy trading. How do you make informed decisions in the stock market? This is a question that many investors ask. The answer lies in the strategies you employ, and these are largely dictated by two main types of analysis: fundamental and technical. Let's start with fundamental analysis. This involves evaluating a company's financial health, industry position, and market conditions to determine its intrinsic value. If the stock's current price is less than its intrinsic value, then it could be a good investment. This is the essence of value investing, a strategy championed by the legendary investor Warren Buffett. Value investors seek out companies they believe are undervalued by the market, with the expectation that their true worth will eventually be realized. On the other hand, growth investing focuses on companies that exhibit signs of above-average growth, even if the stock may appear overvalued in terms of metrics such as price-to-earnings ratios. These investors bank on the company's potential to outperform the market in the future. They are not as concerned with the current price as they are with the company's potential for rapid growth. Then we have technical analysis, which relies on charts and statistical trends to predict future price movements. Day traders often use this method, making multiple trades within a single day to take advantage of small price fluctuations. This strategy requires a significant amount of time and attention, and it's not for everyone. Lastly, a key element of any investment strategy is diversification. This involves spreading your investments across various sectors, geographic locations, and asset classes to reduce risk. Remember, not all sectors perform well at the same time, and diversification can provide a safety net during market downturns. Each strategy has its merits and risks. The key is to find a strategy that aligns with your financial goals and risk tolerance. So whether you're a value investor, a growth investor, or a day trader, understanding these strategies and how they fit into your overall investment plan can be the difference between success and failure in the stock market. Scene script. Are you ready to embrace the roller coaster ride that is the stock market? The stock market can be a thrilling and lucrative adventure, but it's not without its perils. Understanding the potential risks and rewards is key to navigating the complex currents of this financial sea. First, let's talk about market volatility. This term refers to the speed at which the prices of stocks increase or decrease for a set of returns. Higher volatility means the price of a security can change dramatically over a short time period in either direction. Lower volatility paints a picture of stability. But don't be fooled, even the calmest seas can whip up a storm. The stock market is a place where fortunes can be made and lost in seconds. This is why patience is more than just a virtue. It is a necessity. It helps you ride the waves of the market's ups and downs and make decisions based on rational thinking, not emotional reactions. Now, let's consider the concept of buy low, sell high. It's a simple rule, yet it's one of the hardest to follow. Why? Because it's against human nature to buy something when everyone else is selling and sell when everyone else is buying. But this contrarian approach can be the difference between success and failure in the stock market. The risks are real, there's no denying that. You could lose your investment, the market could crash, but the rewards can be equally real. Stocks have the potential for high returns and can provide a source of income through dividends. They offer ownership in a company and a claim on part of the company's assets and earnings. The stock market isn't for the faint-hearted. It requires research, strategy, and a level head, but for those willing to take the journey, it can be a rewarding venture. Remember, the stock market isn't a get-rich-quick scheme. It's a long-term commitment that requires time, patience, and a good understanding of the risks and rewards.